Hi everyone, welcome back to redemption of debentures. Now here in this video we're going to see this last method of redemption, that is purchase in open market. And before moving ahead with this video, please make sure you have watched the first video of this chapter where we have discussed lots of basic things. And then to understand this method properly, you need to know some key concepts such as the concept of accrued interest and the due date, the concept of X interest and cum interest, concept of outstanding interest, and how the debentures are purchased and sold in the open market, how the debentures are traded. If you don't know these four key concepts, then you cannot understand this purchase in open market method. So what you have to do is you have to go to the first video if you don't know these things, and go to the description, see the timestamps over there. If you don't know the concept of, for example, outstanding interest, then you can just go and select that timestamp and watch that portion of the video itself. So you have to understand those four key concepts properly. If you don't know that, then believe me, you can't understand this method. And in this video we are not going to discuss that, okay, because here I'm just going to focus on the method and then the accounting treatment of that. Is that okay? Right. So let's start this video and let's understand this purchase in open market method. Now first let's understand how does this method of redemption works. See, it's very simple. The name says itself, purchase in open market. So the company will purchase its own debentures from the open market from their debenture holders and cancel it off. So when the company issued the debentures into the market, what happened? It was their liability. For example, 13% debentures, it used to be shown at the face value. Now the company wants to redeem their debentures through this method called as purchase in open market. So what is happening over here? The company is purchasing its own debentures. So if it is purchasing its own debentures, then that's becoming the company's asset. It's becoming company's asset. Own debentures account, it's their asset. So since it's an investment, AS 13 will apply over here. Is that clear? AS 13 will apply over here, and if you can see in the balance sheet, there is only one materialistic thing, and of that there are two different accounting over here. On one side you have liability of that only one thing. On one side you have liability and on the other side you have asset. Here it is shown at the face value and here it is shown at the cost. At the cost which they have purchased the debentures from the open market. So what they're gonna do, they're gonna cancel it off. And when they're gonna cancel it off, of course there will be profit or loss, because the prices are different. No, the amounts are different. Here you have face value and here you have cost. At cost which you have purchased the debentures from the debenture holders. Is that clear? So that's what basically will happen. And now when the company will go for this method of redemption, purchase in open market, that's when the market value of the debenture is below the face value. Company uses this method when the debenture's market value is low. Now let's take an example to understand this. See, it's very simple. For example, let's say the company issued the debentures at the face value 100, and after 10 years it is redeemable at rupees 120. 20 rupees extra will be paid to the debenture holders at the maturity after 10 years. Now in the deed, in the debenture certificate, it will be mentioned exactly when the company will have the power to purchase the debentures from the open market back. Now it's not like, if they have issued the debentures on 1st April 2020, then they cannot just purchase the debentures the very next day if the market value of the debentures falls. No, they can't do that. It will be mentioned exactly when they will have that power legally to purchase their own debentures back. Okay, so let's say it was 5th year in that contract, in that certificate, right? So now what happens is, let's say in the 5th year the market price of the debentures rupees 98. It is rupees 98. So isn't it a golden opportunity for the company to purchase its own debentures from the open market and cancel them off? The debenture holders will get what? They will get 98 rupees. If the company waits for 5 years till the maturity, then how much the company will have to pay? The company will have to pay 120 rupees to each debentures. Because they have promised in the certificate, we are going to pay you back at 120 rupees at the maturity. And there is also one other option in the the debenture contract, that the company will have the power after 5th year to purchase their own debentures back from the open market and cancel it off. So isn't it a golden opportunity for the company to do this? Of course it is, and the company will do that. So that's what will happen. Simple. See here, it will be shown at the face value. 13% debenture is the liability. It will be shown at the face value, and they have purchased in the 5th year at rupees 98. So this is the cost of those debentures. So here you have liability, here you have asset, what are you going to do? Cancel it off. They will offset each other. Is that clear? So this is how purchase in open market method works. Simple as that. Is that clear? Yep. So now let's move on to the accounting treatment of this method and let's see the journal entries. Now here we have the accounting treatment of purchase in open market method. First, let's talk about the compliance as to DRR and DRI. See, it's very simple. You all know this. We have to create DRR 10% and DRI 15%. And we do this in the beginning only, on the very first day, as soon as the debentures are allotted, isn't it? Yes, and the entries will be same only. It will not be different. Okay, creation of DRR, creation of DRI, and then you will receive the interest on your investment, and then on the due dates you will pay the interest to your debenture holder. This will happen. But then these two entries will not happen. Which one? The due entry and the make the payment to debenture holder, this entry. Because here, what are we doing? The company is going for purchase in open market. They are purchasing their own debenture and cancelling off. Yeah. So these two entries will be passed, not the due and the payment entry. Is that clear? Yes. But then here, of course, redemption is happening. But before redemption, what happens? Before redemption, you sell the investment. You sell the DRI. So are you gonna sell the entire DRI? For example, let's say 10,000 debentures are there in the balance sheet of the company. In the balance sheet of the company, on the liability side, 10,000 debentures are there, and let's say 1,000 debentures are being redeemed. 1,000 debentures are being purchased from the open market out of 10,000 debentures. So that means only 10% of the debentures are being redeemed through purchase in open market. Only 1,000 debentures are being redeemed. That is 10% of 10,000. Yeah. So what you're gonna do? Are you gonna sell the entire DRI? No. If you had, let's say here, created 50,000 DRI, 50,000 investment, then what you're gonna do is you are gonna sell only proportionate DRI. Yeah. If 10% debentures are being redeemed through purchase in open market, then you're only gonna sell 10% of that 50,000 DRI. Yeah, 50,000 DRI if you had, then you are gonna sell only 10% of that, 0.10. So 10%, that's equal to 5,000. So 5,000 worth of DRI you are gonna sell before the redemption. And then if you had in the DRR also, let's say you had 25,000, just for an example. So if you had 25,000 DRR and you are making the redemption of only 10%, then the transfer from DRR to GR to general reserve will also be proportionately only 10%. So into 0.10, that's equal to 2,500. Yeah. So that's what. Here what you have to do is, and most practically what will happen is, mostly what will happen is the redemption through purchase in open market will not happen like, in the balance sheet. If they have 1 lakh debentures, 1 lakh number of debentures, then entire 1 lakh will be purchased at once. No. Yeah, this will never happen. What will happen is slowly the company will purchase. 10,000 debentures are being purchased out of 1 lakh debentures. Okay, 5,000 debentures are being purchased out of that remaining 90,000, like that. So what you have to do, you have to sell the DRI and transfer from DRR to GR. You also have to do proportionately to the debentures being redeemed. Is that clear? Is that clear? Yes, you understood that. Now let's move on to the approaches we have. Yeah, 2 different approaches we have. We have to understand that. You're clear with the compliance as to DRR and DRI. Yeah, let's move on to the approaches. Now here we have these 2 different approaches through which we can solve the problems of purchase in open market. The first approach is you are going to open own debenture account, and the approach 2 is you are not going to open own debenture account. Yeah. Now you will be thinking that I'm just going to follow approach 2. I will not open own debenture account and all. It will be easier for me. Yeah. I'm just going to forget about this approach 1. No, you can't do that. Why? Because in the exam what can happen, the question can specifically ask you, and we have that one illustration also, the question will specifically ask to open own debenture account. If the question asks you that, then that's the requirement. To get the marks, you have to follow the approach 1, otherwise you will lose the marks. Sometimes the question will be silent. If the question is silent, then you can follow the approach 2. Is that clear? Right. So let's understand the approach 1 first, and then approach 2 will be very easy, just the combination of this. Is that clear? Right. So let's start. So see here, what is happening in this method, purchase in open market. The company is going into the open market and purchasing its own debenture. So when the company does that, then the debenture becomes the asset. It becomes investment. So as I've told you, AS 13 will apply and we have to do investment accounting. So this entry is of investment accounts only, isn't it? See here, we have purchased our own debenture. So of course you have to take the name of own debenture account, debit, and you will take X interest price. We'll come to that in a minute. Yeah, and then you're going to debit debenture interest account, and that's called accrued interest price you have to take, and you are going to combine these two and pay that off. That is called cum interest price. And of course you're going to credit the cash or bank account. Is that clear? Now what is X interest, accrued interest, and cum interest? I'm sure you haven't watched the first video or something. Yeah, so see, it's very simple. What happens is, take this example. Let's say, actually this slide is from the investments accounts. Yeah, so now here just think that this Q is a company, okay, not a person. Is that clear? Right. So let's understand this. See here, Q purchased 1010% debentures of face value 1 lakh on 1st March 2020. Due date for the interest payment is 30th June and 31st December. Now what is due date? Due date is a date when the interest will be paid to debenture holders. Okay, so in India it is mostly every 6 months. So for example, let's say 30th June and 31st December, and the closing date of this company is also 31st December. Is that okay? Right. So now here what is happening? Q company has purchased 1000 debentures from this person called as P. Okay, and this transaction is happening on 1st March, that is between the due dates. See here, this is due date, this is due date, and the transaction is happening over here. Yeah, and mostly every time this will happen, the transaction, the purchase and sales of the securities happen in the open market between the due dates. So when that happens, the concept of accrued interest comes into the picture. Yeah, see here, this Mr. P was the owner of those debentures. Yeah, he held those debentures till 1st March. Yeah, last interest was paid on those debentures, yeah, on those 1000 debentures on 31st December last year. Yeah, so now how many months have been passed after the due date? 2 months have been passed. January and February, isn't it? January and February. So January and February interest has been generated till the date of transaction. From the last due date till the date of transaction, 2 months interest has been generated, isn't it? Debenture, what? Debenture is a fixed income bearing security. It follows accrual concept. The interest, the income on the debentures gets accrued as the time passes by. As the months passes by, the interest gets generated. So that 2 months interest which has been generated till the date of transaction, it is entitled to whom? It is entitled legally to Mr. P. Yeah, so what will happen is, when Mr. Q, sorry, not Mr. Q, the company Q will purchase the debentures, the company will have to pay the market value of the debentures, yeah, which will be the cost for company Q. Yeah, the company has to pay that to Mr. P, the market value of the debentures, as well as the accrued interest, the interest that has been generated till the date of transaction. And how will you calculate that? It's very simple. See here, for example, let's say, you know, the face value only. Let's say the market value is equal to face value, just for an example. Yeah, so you will take that 1 lakh, the total value of the debenture, yeah, the market value, into what you're going to do? Not sorry, market value. You're going to take the face value. Yeah, take the face value into what? 2 months interest, right? So 2 divided by 12. And what's the rate of the interest? Rate of the interest is 10%. So into 0.10. So that's equal to, see here, 1666.66. Yeah, so this much interest also the company has to pay along with the market value. Is that clear? Market value is being paid, which is the cost for the company, and the accrued interest together. Is that clear? So this cost of the investment, yeah, the cost of the debenture, it is called X interest price. Just the cost is called X interest price, and with this X interest price, with this cost, if you include that interest, then it becomes cum interest price. See here, X interest, the cost of the investment, plus accrued interest, the interest that has been generated till the date of transaction. If you add these two things together, then you have cum interest. Yeah, now in the question what will happen is, the question will specifically give you some time whether it is X interest price or cum interest price. The transaction has happened on this price or this price, the question will tell you. If cum interest price is given, then you can understand that accrued interest price is included in that, and you will separate it. Okay, or sometime what can happen, just the X interest price will be given, you will take the X interest price and you will calculate accrued interest and you will record that. Yeah, but now sometimes what can happen is, the question will be silent. The question will not tell you anything. They will just give you an amount. If they just give you an amount, then you have to assume it is X interest. Is that clear? That's what you have to do. Okay, so X interest and cum interest is nothing but just the two way of quoting the prices. Okay, if just the cost is given, that's X interest. If a price is given in which the cost as well as accrued interest is included, then that is cum interest price. Is that clear? So that's the concept. So here what you're going to do in this entry, you're going to take in the own debenture account, the debenture which you have purchased, that asset, you are only going to take the cost of the investment, the market value, yeah, what you have paid, only that you're going to take. And then here in debenture interest account, you're going to take the accrued interest, the interest that has been generated till the date of transaction. And the shortcut for that, the calculation is what? Last due date till the date of transaction. That's how you're going to calculate, isn't it? See here, January, February, isn't it? The last due date was 31st December. So from 31st December till March, how many months have been passed? It's 1st March, so you will not include March. January and February, 2 months. Last due date to date of transaction. That's the shortcut you're going to use for the periods. Is that clear? Right. So that's the accrued interest, and if you combine these two things, that's equal to cum interest. So that's the amount you're going to pay to the Mr. P. Is that clear? So this is the entry for the purchase of own debenture. Simple, you understood? Now if you're wondering why are we debiting this debenture interest, then it's very simple. See here, you are paying this interest. This is an expense for you. So what do we do with the expenses? We debit that. Simple as that. Clear? Right. Next entry is cancellation of debenture. Here you have purchased. When you purchase the debenture, what happened? It came into your balance sheet on the asset side here. Yeah, and then what do? You cancel both the things. Yeah, the liability, which is at the face value, and the own debentures, which is at the X interest price, at the cost. Yeah. So what you're going to do? You're going to cancel it off, isn't it? See here, cost, and this is the face value. So see here, the entry is very simple. To cancel off the liability, what you're going to do? You're going to debit that. Liability have credit balance. To cancel them off, you're going to debit. Yeah, that's what we used to do in the normal redemption also, in lump sum and all, isn't it? To cancel off, what we used to do in the due entry, remember? We used to debit the percentage debentures account with the face value only. That same thing you have to do. See here, percentage debentures account debit to face value. Yeah, with the face value. Is that clear? And then that asset which you have on the asset side, own debenture account, that also you have to cancel. So you are going to credit that with the X interest price. See here, it is debited over here. You have recorded the asset. You are cancelling it off to own debenture account X interest price. Is that clear? Simple as that. And then of course, as I have told you that, the liability is at the face value and the asset is at the X interest price at the cost. So of course there will be profit or loss. But what I have told you that mostly the company goes for this method when the market value is low, mostly lower than the face value. Yeah. So what will happen? Mostly 99% of the time there will be profit. Yeah, there will be profit only. And what do we do with the profit? We take the profit over here to profit on cancellation account. It's our income, right? It's our gain. So what do we do with the gains? We credit that, yeah, to profit on cancellation. If there is a loss, just for an example, if there is a loss, then what are you going to do? You're going to take it over here on the debit side. Percentage debenture account debit, loss on cancellation account debit. What do we do with the losses? We debit them. So loss on cancellation account debit to own debenture account, like that. Simple as that. Is that clear? Right. Now, the profit or loss and cancellation, you have to transfer that later to profit and loss. Is that clear? You have to. Before, people used to say that, we have to transfer it to capital reserve. Now, nothing is there like that. Yeah, you have to just transfer it to profit and loss. Simple as that. Is that clear? Right. Still, the clarity is not there on that, but most of the big faculties are doing like that only. They are transferring to profit and loss. Is that clear? Right. So that's what you have to do. Clear? And then see the notes over here. If the question doesn't specify X interest or cum interest, then you have to assume X interest. As I told you that in the question, they will give you one price. Yeah, see here how the price is given over here, 98 rupees. Yeah, the debentures have been purchased at 98 rupees like that. So like this, prices will be given and they will tell you whether it is X interest or cum interest. Yeah, if they don't tell you anything, then what you have to do, you have to think it is the X interest price and calculate the accrued interest separately. Is that clear? If they tell you it's cum interest, then in that only you have the accrued interest. Just so calculate the accrued interest and separate that like that. You will understand practically when we solve the problem. Don't worry, it's very simple. Fine. So that's what. If nothing is being said, the question is silent regarding X interest or cum interest, just assume it is X interest. Yep. And then if question asks for own debenture account, follow this approach. That's what I told you. You have to follow the approach 1 when the question asks open own debenture account. Is that clear? Right. Now let's move on to the approach 2. Now approach 2 is very simple. Yeah, see here, approach 2 is just a combination of these two entries. See here, you have own debenture account over here, you have own debenture account over here. Just cancel these two things, own debenture, own debenture. What do you have? The entry is what? See here, percentage debentures account debit. You are cancelling of the liability with the face value, same thing. You're taking this, you take all the debits, percentage debentures account debit, face value, and of course debenture interest will be there, that accrued interest which you have to pay, right? So you will take that, debenture interest account debit accrued interest from the last due date till the date of transaction. You will calculate that on the face value, not on the market value. Interest is always calculated on the face value. Okay, you have to calculate this on the face value, right? So, and then what, you will pay that whole amount to bank account come interest. Yeah, so see that X interest price also properly, but you are not gonna take it separately over here as own debenture account because we are not opening own debenture. But in the come interest, what should go? The accrued interest plus X interest should go in this come interest price. Is that clear? That's what you're paying to that party from whom you are purchasing. Yeah, to your debenture holder, because you're purchasing the debentures from your debenture holder only. Is that clear? You understood? Right. And then of course, as I told you, the difference between the face value and the X interest price will be profit or loss. Yeah, the balancing figure actually in this, the balancing figure will be profit on cancellation or loss on cancellation, and this has to be transferred later to profit and loss, only to profit and loss. Okay, there is no now argument. Before there was argument to capital reserve or to profit and loss. Now it's simplified, only to profit and loss. Simple as that. Yeah, you understood? Just the combination of these two entries, nothing more than that. The logic and everything is same only. Face value, liability, cancel it off, accrued interest, last due date to due date of transaction. In the come interest, what do you have? X interest price and accrued interest. Is that clear? Yes. And then here, see, note, if question doesn't specify X interest or come interest, assume X interest. The same note. Is that clear? Right. If question does not ask for own debenture account, follow this approach. Yeah, this is easier, right? It's just the combination. So if the question is silent, question is not asking for own debenture account, then you have to follow the approach 2. Is that clear? Did you understand? Was it difficult? No, it's very simple. Yeah. And then, we'll be making use of this working note for the calculation of X interest and come interest. Yeah. And accrued interest. It's very simple. Yeah, date of transaction, face value, because interest is always calculated on the face value. You're going to take that. Actually, this is from the investment accounts. Yeah. So ignore the brokerage and all. Okay. Brokerage will not be there. Fine. So that's what. So this is the period you're going to be taking from to the dates. Yeah, last due date to date of transaction, like that. If there is outstanding interest, then what you're going to do? Last due date to the year end, like that. Okay. And then number of months. How many number of months are there in these two periods? And then X interest will calculate come interest. Yeah, it's simple. We'll see that practically. Don't worry. So this was the method of purchase in open market. It's not difficult at all. It's very simple. All right. Okay then. See you in the next video.